Hey everyone, so this is Wally with Asset Guidance Group again, and let's finish up the solutions for last week's problem that we set up for the Trump tariff strategies and the impending doomsday debt that's due just on the short-term obligation of the huge 33, 34, 35 trillion dollar United States national debt. So again, just last week, let's just quickly review where we were. So the problem that we set up was at the current average cost of maturing debt, okay? The September in 30 months, the amount of debt that the United States has to refinance, has to pay off, has to refinance, has to do something with, is about $1.6 trillion, a little bit more than that, between 1.6, 1.7 trillion, it's closer to 1.6 trillion dollars at current interest rates, okay? And that's double the Pentagon budget, so it's untenable, it's unsustainable, and so the Trump solution right now that we've seen, or that we saw up through last week, was that it was going to impose these tariffs, okay, and then correspondingly devalue the currency because, as we saw, and we'll see again in the next chart, we'll review that a little bit. You have to do that in order to make the tariffs work. So we saw that overall, the total tariffs that would be brought in would be just about $2.25 billion. So somewhere between about 224 to 254 billion dollars from the tariff revenues as of September 2027. So that's not going to make a huge dent in the 1.6 trillion due. Okay, to refinance this short-term debt, even if he used it all. So, what is he really planning on doing with that? Probably using some of that to offset the planned tax cuts that would be used as an incentive. So the strategy here, the incentive is to repatriate American manufacturing, okay? Make the companies need to go home and come home, all right? And so previously we saw them repatriate $1 trillion of assets that have been deployed overseas. That was that was a better part of 6, 7, 8 years ago. Now what we're seeing is the strong arm tactic. We're going to tariff you back to the United States. So you could either say the 1.6 trillion offset by the 240 trillion dollars would be roughly leave about 1.4 trillion that would still be left and due if they use it all for that debt. Well, we know that, and the Trump administration announced last week, so we learned a lot last week, but last week a plan B, okay, is that they are using the United States military as sort of mercenary forces in conjunction with appeasing our close ally Israel, and as well as our own interest in persuading Iran or dissuading Iran from developing nuclear weapons. The Trump administration has ordered probably about the neighborhood of 120,000 troops redeployed from Europe to the Middle East, okay, around the UAE. And to put a little more pressure on Iran for denuclearizing, and also, or to keep it from nuclearizing at all, and also as a buffer to protect Israel simultaneously with the allies and other allies in the region, the Saudis, etc., because the oil shipments that are there. So energy is a big deal. And in exchange for that, the UAE is reportedly going to invest in the United States. Ready for this? $1.4 trillion. I'm sure it's a coincidence, okay? Anyway, so that's out there. It's a good news. I'm calling that a plan B because I'll show you what real plan A is here in just a second here. But let's continue to review here. That's what they're going to do with that $250 billion. the tariffs, will they offset the trade deficit? Trump has a couple of goals here. He wants to reduce the income tax if he cannot eliminate it. He wants to reduce the income tax. He wants to go back to the golden era of where the federal government raised its revenues through tariffs. And so he wants to repatriate American manufacturing and increase United States GDP. And he also wants to solidify the status of the American currency as the world reserve for global trade. Now, we saw last week in this chart that in order to make the tariffs work, you have to devalue the dollar, okay? You have to devalue the domestic currency, because otherwise it's merely offset in time through exchange rates. When you impose tariffs, it merely offsets the tariff by manipulating the currencies, and so the foreign nations devalue their currency, and so your exchange rate goes up, and that offsets the tariff. Okay, the impact of the tariff. It does not, as you'll see by this vertical blue line here, that's the equilibrium in the trade deficit. Okay, and that's capital inflows. So the diagonal line to the far right is the current trade deficit. Then you impose the tariffs, and we see that diagonal shifts to the left. Okay, so the second diagonal is the current trade deficit after the tariffs, and the x-axis is the capital inflows. The y-axis is the exchange rate, and you see that the equilibrium point where the intersection of the blue line is that it merely moves up the exchange rate axis, and it does not adjust capital inflows. Now, why does that happen? Because, as you see, the current trade deficit, that diagonal line, that's the difference by definition of the net imports minus net exports, or vice versa, okay? In our case, since we're a debtor nation and we import more than we export, then we have the net imports minus the net exports, and that's the trade deficit. It's the current trade deficit. Since we run trade deficits, look at the x-axis, the capital inflow, as the balance sheet side of the trade deficit, okay? So in order to balance the trade ledger, you have to have capital inflows from the world that you're running a trade deficit against. And so you want that foreign investment that has to come in to offset the current trade deficit. That's just accounting. It's a balance sheet. Think of it as a balance sheet, okay? That's how it works. So this proves why if you don't devalue the currency, the tariffs are neutered. They're ruled nugatory by merely exchange rates. And so the exchange rate goes up when you impose the tariffs, okay? And that's because the cost of other goods that you're importing offset the tariff. So overall, you have an inflationary impact by the imposition of the tariff. So if you want the tariffs to work, you also have to devalue the currency. So then you would see an actual shift to the left in capital inflows. If you have a downward move along that y-axis of a devaluation in exchange rate from where the blue line first intersects the far right diagonal, the current trade deficit, if you shift that over to the left, you see that axis, if you hold the exchange rate the same or decrease it, if you devalue the currency, then you're going to shift that vertical blue line to the left. And so that means you're going to have a corresponding movement to the left, a decrease in capital inflows on that x-axis, okay? That should be intuitively obvious to you. And so you're going to have a reduction in capital inflows. And what have we seen? Well, we've seen the dollar devalue since Inauguration Day, okay, the 54 to 60 days worth of Trump administration that it's been, and we've seen a steady decrease in that value of the dollar. We saw a little bit of blip on it last week, but overall, what we see here is a decrease of about a net 4.33% prior to last week's bump up, and so you see a net right now decrease in the devaluation of the dollar about 3.2%, something like that. It's right around that. But anyway, the point is that it's devaluing, and this is why they have to devalue it. The other chart proved that. Okay. Now, what have you also seen in the price of assets? Well, equity assets, etc., sold off, didn't they? That money went back home. That takes care of the trade deficit, right? So that money went back home to Europe, by and large, and so you see, and to Japan, okay, and to China, all right. So that money is no longer invested in equities. You saw that big drawdown, all right. So that's a corresponding, that proves out that other chart too. It kind of moves along that the capital inflows reduced, okay? So no money, the capital was being invested in the United States. As a matter of fact, the opposite was happening. Capital was leaving the United States, going back home. And that's what it is. And you can see that happening in the DAX in Germany, and the equities in Germany and Europe generally increasing quite a bit. So you see that. All right, so then that is what has been going on. Now, the solution that Trump has, this is really a lot of noise. And because the solution to set it up to get where he wants to be, the solution is really this executive order of March the 6th, 2025. And what did that do? Well, that established a United States strategic crypto reserve. And let me pull up this other chart for you here. I have them both here. What that's really showing us is that I'm going to start using a different term, okay? Because we're lumping everything into crypto, okay? And there's a difference here. So you've got Bitcoin, you've got other cryptocurrencies, but really what's going on right now, so they're going to establish that. Let's set aside Bitcoin for the time being. That's a discussion for another day. What we want to focus on today is the solution as being a proliferation of stablecoins. So we've got this early short-term maturity debt that we need to pay for, right? We need to refinance it. People around the world, and Trump also wants to keep the United States dollar as a go-to reserve currency. People around the world want the United States dollar, and they want as a medium of exchange, and they also want it so that they can invest it in the United States equity markets, stock markets, bond markets. They want to invest in the United States because no one anywhere has the kind of liquidity that the United States does in our markets. And so these are mature markets, they're well regulated, they got a good rule of law. That's where people around the world want to invest. Well, how do we get there? To make it easier, and you got to credit the administration for the foresight that they saw in recognizing this. The other side last summer didn't see it, and they were going about it a bad way that the industry itself didn't even agree with. The other guys were really looking for a United States central bank issued digital currency, okay? That's not going to happen. The industry didn't want that to happen. So without disrupting the industry and to keep things privatized, then Trump did see it. The Trump team saw it, and they saw it early on enough, and this is what won the election for them, in my view. And they got this entire industry behind them. So there's a thing called stablecoins. The reason that a lot of people are a bit leery about investing in crypto generally, and we're going to stop using that term broadly, but there's a lot of volatility. I'm going to do a whole session here, you guys, the difference between volatility and risk, okay? We'll talk about risk, but there's a lot of volatility, and people want to get away from that. So what has been developed is this thing called stablecoins. And so they are pegged to the value of the dollar. Now, this is huge. This is going around the world fast. There are so many banks right now issuing stable coins, or going to be issuing stable coins, and you're going to see increasingly amount of this. What is it? A stable coin is a digital asset, a cryptocurrency, if you will, that's tokenized. It's purchased shares of short-term government obligations, okay? Those same things that we're talking about here for a couple of weeks that have to be refinanced. And what they're talking about doing is, well, actually what they are doing, Franklin Templeton has been doing this with longer termed treasuries. You're going to see increasing in numbers. Right now you have a company called Tether. They started doing it, and they're the world's largest capitalized as we speak. BlackRock is going to be doing this. 143 billion in U.S. short-term treasuries have been purchased by USDT, okay, that Tether, and they've made a stable coin USDT. And the thing with USDT is it's tokenized, okay? And so that means it represents ownership of shares of, like, money market, short-term treasuries, obligations, okay? And they're pegged to the value of the dollar. That's why they're called stable. They're stable coins. And they can transfer value in terms of US dollars around the world at the speed of light. So if you're in Argentina, and you want to invest in the New York Stock Exchange, you can do it with your current equivalent currency there. There's no middleman. You simply convert your Argentinian pesos, whatever they're called, bazingas, into USDT. Now you can invest your currency is no longer, it is much more stable because it's in the dollar. It's not devaluing, it's not inflating like your local currency is. Plus you can invest it in the world exchanges in terms of decentralized exchanges as well as centralized exchanges if you want pieces of the United States equities. So you can invest it that way, no matter where you're at. If you're in Hong Kong, if you're in Argentina, if you're in Peru, if you're in India, no matter where you're at, this is available to you at the speed of light. Now, on top of that, this other company, Circle, is the other large player as we currently see in this segment of the industry. Theirs is called USDC, same concept. It's just USDC. You're going to start seeing BlackRock, Franklin Templeton, Bank of America, Wells Fargo, all the major banks, okay? All of these, JP Morgan Chase, all of these banks, if they're not going to fall by the wayside like Kodak did, they're going to have to recognize what the public's demanding and where the technology is headed, because this is so much more efficient than the current system of exchanges, ADRs, middlemen, exchange rates, all of this delay and time that's used. These markets will be open, available 24/7, okay, 365. And the market cap of USDC, most recent data, is right at 60 billion. So if you take 143 billion with USDC and 60 billion with USDC, that's your magic 200 billion, same as the tariffs basically, that were coming in. If you add all the smaller players around that are in these markets as well, you're capitalized right at that same amount of money as are the tariffs, okay? and you can still fund international transaction via the chain in the same amount of denomination of dollars. So easy trade-off there, that's pretty obvious to see. But also the growth rate in stablecoins, which by definition are only created by the purpose, they have to show that they're backed up, they're secured by short-term United States treasuries. This market is projected to grow by September 2027. How much? About $1.6 to $1.7 trillion, very easily. Kudos to the Trump administration for believing in the private sector, for seeing that this is possible and doable, and creating the environment to where this is now legitimate in the United States and is doable. So the legislation is going to be in place by August of 2025, so less than 6 months from now, and you're going to also see regulations start being developed and pro stablecoin regulations and pro digital asset regulations generally, and that's going to carry out. And that's going to be a lot slower than the industry is going to want. But the big deal is that the SEC is standing down, and they're going to let this industry develop. And this is very popular around the world. Everybody around the world wants this. It'll maintain the strength of the dollar, so it'll offset those tariff devaluations. That's probably going to be a short-term deal. Also offset the inflationary impact, and you'll still maintain the dollar as the go-to. It'll just be it'll be a tokenized dollar, but it'll still be the go-to currency around the world. Voila, problem solved. All thanks, really, in large part, as a derivative fashion to Bitcoin, but that's another discussion for another day, all right? You should feel better about things, because this is going to be the way that the future is paved, and it's going to be the solution to getting us, the United States, out of this tremendous national debt load that we've been carrying. And it's going to change. It's going to change things. All right. A lot of new stuff coming down the road for you, but this is what we see. And I've talked to people all over the world, with the industry leaders. We all spent a week together last week on Wall Street and in Manhattan, and that's where we're headed, folks. Hang on. We're going to bring you this and all kinds of other news. All right, smash that like button if you liked what you learned today, that there is a solution, and share this, and subscribe to the Substack. Okay, pass this around, and if you want to learn how to start investing in these things, we're rapidly building our platform to be able to accommodate you. And so there's a lot of moving parts to invest in the crypto as it is right now. The DeFi exchanges, the central exchanges. Okay, on the one hand, it's easy. On the other hand, you can chew up your capital pretty quickly if you don't know what you're doing. So we're out there to help you. We are bringing you. We're staying cutting edge, and so we are excited about bringing this news to you. And we're developing increasingly our capacity to bring you more and more value in this area. So stay tuned, subscribe, like, and share. See you next time.